The Ministry of Finance has reportedly given Malaysia's mobile network operators, or MNOs, until August 31st to agree on the terms related to the acquisition of shares in 5G network provider Digital Nasional Berhad, or DNB. Finance Minister Tengku Datuk Sri Zafrul Abdul Aziz was quoted by the Malay Mail as saying that the MNOs will have to agree to the terms by the new deadline or risk losing out on 5G access. The government previously set a June 30th deadline for the telcos to agree on the 70% stake purchase in DNB, a company owned by the Ministry of Finance, or see the 5G spectrum opened up to foreign players. Following the telco's principal acceptance at the time, official announcements were expected to be made the following week, but it is understood there was further back and forth to iron out related conditions. In the report today, Zafrul was quoted as saying that it is very hard not to allow in foreign players who are queuing up for access to the Malaysian market. However, he said local telcos should be given the first bite. Malaysia Aviation Group (MAG), the parent company of Malaysia Airlines, has selected the Airbus A330neo aircraft as part of the flag carrier's medium-haul fleet renewal program. Powered by the latest Rolls-Royce Trent 7000 engines, the 20 A330neo planes will join the carrier's fleet of 6 long-range A350-900s and gradually replace its 21 A330 CEOs. MAG said Malaysia Airlines will operate the A330neos on its network covering Asia, the Pacific and the Middle East. It will configure the A330neo fleet with a premium layout, seating 300 passengers in 2 classes. MAG inked today memorandums of understanding for the purchase of 10 A330neo aircraft from Airbus and the lease of another 10 from Dublin-based Avalon. Its Chief Executive Officer Isham Ismail said, "The acquisition is a natural transition from the group's current A330 CEO fleet." He also hailed it as a significant milestone as MAG moves towards the successful execution of its long-term business plan 2.0 to position itself as a leading aviation services group within the region. Bursa Malaysia says its technology index's forward price-to-earnings ratio (PER) has compressed or fallen to 22.9 times currently from slightly above 30 times at the start of the year, as share prices of the technology index's constituents rebounded on bargain hunting. Analysts at Bursa's research arm, Bursa Digital Research, wrote in a note that the index's current PER of 22.9 times values the 42 stock technology gauge at around its 5-year average forward PER, but at the top end of its pre-COVID-19 pandemic PER valuation band. The note highlighted that the technology index has rebounded slightly by over 16% in the last 3 weeks, off its July low, its lowest level since October 2020. The rebound is broad-based as it saw 37 out of the 42 index's component stocks advancing off the July lows. In general, the year-to-date earnings trend and target price revisions for the sector were negative, but overall, analysts are keeping a positive bias on the sector. At 5 p.m, the technology index closed up 0.03% at 67.03. In contrast, the FBM KLCI fell 0.14% to 1,504.01. Hong Leong Investment Bank Research (HLIB) has maintained its buy rating on Heineken Malaysia with a higher target price of RM30.85 from RM28.87 previously. The research house said Heineken's first half FY22 core net profit of RM199.5 million, which doubled year on year, came in above both house and consensus projections at 58% and 63% respectively. In a note today, HLIB said the positive results surprise was due to higher than expected beer demand following the nation's transition to COVID-19 endemicity. Going into the second half, it expects beer sales to remain strong, considering the pent-up demand for out-of-home drinking, the strong return of foreign tourists, and the 2022 FIFA World Cup. In particular, the depreciating ringgit bodes well for local tourism, which should lead to stronger foreign visitor arrivals. Despite lingering concern following Heineken's move to raise beer prices by 6 to 8% effective August 1st, HLIB is not overly concerned as beer remains the cheapest alcoholic drink in the market, which translates to relatively inelastic demand. It raised its earnings forecasts for FY22 to 24 by 2 to 7%. Heineken ended trading today 1.23% higher at 24 ringgit 70 sen for a market capitalization of 7.46 billion ringgit. Independent advisor Kenanga Investments Bank says the takeover offer for Cycle and Carriage Bintang CCB at 2 ringgit 70 sen per share is not fair but reasonable. In a circular to CCB's shareholders, it noted Jardine Cycle and Carriage's offer price represents a discount of 1 ringgit 26 or 31.76% to the estimated revised net asset value RNAV per CCB share of approximately 3 ringgit 96. The offer price is therefore not fair. Having said that, Kenanga highlighted that shareholders should take note that the estimated RNAV represents the fair value of the CCB Group's assets, with a deemed presumption that CCB is able to sell all its assets on a willing buyer, willing seller basis in the open market in the immediate to medium term at the indicative market values. It said there is no absolute assurance that CCB will be able to realise the full value of the estimated RNAV for each CCB share, nor is there any certainty that the share market would reflect the fair value of CCB shares in the future. Kenanga said the offer is reasonable based on the historical price of CCB shares for the last 12 months up to the last trading date. The independent advisor said the offer price of 2 ringgit 70 represents a premium of between 2 sen and 1.86 sen over the last traded market price of CCB shares on the latest practicable date LPD of 2 ringgit 68 and the 5 market day volume weighted average market price of CCB shares up to and including the LPD. Meanwhile, the offeror does not intend to maintain CCB's listing status, and CCB shares are relatively illiquid, so it's an opportunity for shareholders to realise their investment.